Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. March 2026 is shaping up as a repricing month for global assets, and the catalyst is clear: the Federal Reserve's March 17th through 18th FOMC meeting. Right now, Fed funds futures are pricing in a 96% probability of a hold. But the real action isn't about this meeting's decision. It's about forward guidance, dot plot revisions, and Chair Powell's press conference commentary that could reset expectations for the entire year. Let's start with the institutional split that's driving positioning. According to Goldman Sachs and Morgan Stanley, the next rate cut isn't coming until June 2026. Meanwhile, Citigroup and Wells Fargo are projecting a March cut. This divergence among major banks isn't just noise. It reflects genuine uncertainty about inflation, persistence, labor market dynamics, and the Fed's reaction function. When the smart money can't agree, volatility follows. The January CPI data came in at 2.4% year-over-year headline, 2.5% core. That's progress from where we were, but it's not the sustained move toward the Fed's 2% target that would justify immediate easing. The critical data point coming up is PCE inflation on March 13th. This is the Fed's preferred inflation gauge, and any upside surprise here would push rate cut expectations further out and trigger immediate repricing across risk assets. Employment trends are adding to the complexity. Recent months have reported job additions of around 130,000 positions, with unemployment rates in the 4.3 to 4.4% range. As reported by Goldman Sachs research on Fed employment forecasts, this cooling but resilient labor market gives the Fed flexibility. They're not facing a crisis that demands emergency cuts, but they're also not seeing runaway wage growth that would force extended hawkishness. Now let's talk cross-asset implications, because that's where traders need to focus. In bond markets, we're seeing positioning for significant repricing based on whatever guidance comes out of the March FOMC. If the Fed signals that inflation remains stickier than expected, front-end Treasury yields will move higher. Goldman Sachs analysts have projected a terminal rate scenario around 3.25% if rate cuts eventually materialize. That's critical for understanding where yields could settle once the cutting cycle completes. The yield curve dynamics are particularly important right now. A hawkish hold with pushed-out cut timing would likely steepen the curve as the market prices in higher rates for longer in the short end while maintaining long-term growth expectations. Conversely, dovish guidance could flatten the curve as rate cut expectations get pulled forward. Equity markets are showing heightened sensitivity to these rate expectations, particularly in the growth versus value rotation. Rate-sensitive growth stocks remain vulnerable to hawkish surprises. Think about high-multiple technology names, unprofitable growth companies, and long-duration equities. These assets get hit hardest when discount rates rise. On the flip side, financials could benefit from sustained higher rates through improved net interest margins. Real estate investment trusts and utilities face headwinds in a higher-for-longer scenario due to their leverage and income-oriented investor base. Sector rotation preparation is active right now among institutional managers. According to market analysis from GeoMarkets on U.S. market drivers for March 2026, defensive positioning has increased ahead of potential volatility. Active managers are setting up for potential pivots based on what the Fed signals. That means watching relative strength between growth and value indices, monitoring sector flows, and tracking volatility positioning in options markets. Cryptocurrency markets deserve particular attention this month. Bitcoin and major altcoins are displaying correlation with traditional risk assets, which means they're trading more like high-beta equities than uncorrelated alternatives. Leveraged crypto positions are creating amplified volatility potential. According to Yahoo Finance reporting on FOMC minutes and crypto market movements, digital assets have become especially sensitive to rate cut expectations. USD strength from sustained higher rates creates additional pressure on crypto valuations, since many investors view digital assets as dollar alternatives. Let's map out the 3 risk scenarios traders should prepare for. Base case: the Fed holds rates in March, provides dovish forward guidance suggesting June cuts remain on the table, and the market rallies on risk-on sentiment. This scenario supports equities, particularly growth names, keeps the dollar relatively stable, and allows crypto to recover from recent weakness. Bond yields would likely drift lower on the long end, while the short end prices in near-term cuts. Hawkish surprise scenario, inflation data comes in hot, or Fed guidance turns more restrictive than expected. This triggers sharp USD strengthening as rate differentials favor the dollar. Equity markets correct, especially in growth sectors that borrowed forward multiple years of earnings. Crypto sees significant volatility with leveraged positions getting liquidated. Bond yields rise across the curve with particular pressure on the front end. Dovish surprise scenario, weaker economic data or unexpectedly accommodative Fed communication. Risk assets rally hard. USD weakens against major currencies. Yield curves flatten as rate cut expectations accelerate. Crypto markets recover as the liquidity outlook improves. The calendar for March is packed with market-moving events. March 13th brings PCE inflation data, which is make or break for near-term Fed expectations. March 17th through 18th is the FOMC meeting itself, with the policy statement and updated economic projections. Then Chair Powell's press conference, where every word gets parsed for directional clues on policy timing. Volatility trading is heating up around these dates. Options markets are pricing in elevated volatility, which creates opportunities for those positioned correctly and risks for those caught on the wrong side. According to analysis from XT Exchange on what will move markets in March, currency hedging activity has increased among international investors monitoring USD movements for portfolio impact. Here's what matters for positioning right now. If you're long growth equities, understand your exposure to rate sensitivity. Consider hedging with short duration value names or defensive sectors. In fixed income, the front end of the curve offers opportunities if you believe cuts are coming sooner rather than later, but carries risk if inflation surprises to the upside. For crypto exposure, recognize the correlation with risk assets and the amplification effect from leverage in the ecosystem. The dollar is a critical cross-asset variable. USD strength pressures commodities, emerging markets, and crypto, while supporting domestic large-cap multinationals that benefit from repatriation dynamics. USD weakness has the opposite effects. Right now, the dollar's direction depends almost entirely on Fed guidance relative to other major central banks. International market reactions will matter. If the Fed maintains a hawkish stance while the European Central Bank or Bank of Japan ease more aggressively, rate differentials widen and capital flows shift. That affects everything from equity valuations to commodity prices to crypto market liquidity. One underappreciated risk is the feedback loop between asset prices and Fed decision-making. If equity markets sell off hard before the March meeting, does that change the Fed's calculus? Financial conditions tightening through market mechanisms could influence their guidance even if underlying economic data hasn't shifted dramatically. The Fed watches market pricing, and markets watch the Fed, creating a reflexive dynamic that can amplify moves in either direction. Goldman Sachs' insights on the outlook for Fed rate cuts in 2026 emphasize that the Fed's path remains data-dependent. That's not just central bank speak. It means every CPI print, every jobs report, every inflation indicator matters for rate expectations and therefore asset pricing. The March FOMC won't exist in isolation. It's part of an ongoing recalibration between economic reality and market positioning. For traders, the signal-to-noise ratio is critical right now. Focus on the data that actually moves Fed expectations: PCE inflation, employment trends, wage growth, and financial conditions. Ignore the speculation and focus on what Chair Powell has explicitly said matters for policy decisions. The setup into mid-March is for compressed volatility followed by expansion. Markets are holding tight ranges waiting for clarity. Once the PCE data hits and the FOMC delivers guidance, that compression releases. Be positioned for the move, not caught flat-footed trying to react. Bottom line, March 2026 is a repricing month across stocks, bonds, and crypto. The Fed's March 17th through 18th meeting, the fulcrum. Institutional divergence on cut timing creates opportunity for those positioned correctly and risk for those on the wrong side. Watch PCE on March 13th, watch the FOMC statement and projections, and watch Chair Powell's press conference for the guidance that will set the tone for Q2 positioning. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.